Yo, what's up, traders? My name is Daniel James, and some of you know me as D Trades on TikTok. So, I'm really excited for this video because I'm going to be breaking down strategy that I use that has been missing consistent results in my trading, and the strategy I'm also implementing in my $5,000 prop firm challenge. So, I'm going to be using this strategy to pass it. So, this video is going to be part of a larger series where I break down the exact trading process, my whole strategy, everything for you because I want it to help people out there. So I'm not charging a dime for this course. I'm not charging a dime for you learning this strategy. So let's get into it. The main strategy I use is supply and demand. That's it. It's that simple. Supply and demand. So some of you that are new may be asking, what is supply and demand? Well, supply and demand is an area where the market experienced a large push away, like a large movement. So now it depends on the context. Demand zone is an area that the market experience where price is pushed up rapidly. Like now, this is a demand zone. You can see this large candlestick pushing away from it. A supply zone will be in the opposite order. So this is how a supply zone will be. Instead of it pushing price in the upward direction as in the demand zone, a supply zone will see price being pushed in the downward direction. Supply zones form when institutions place large sell orders, driving price down. Demand zones form when they place large buy orders, pushing price up. See, like here, pushing price up. So if you can identify these zones properly, you will know exactly where price is likely to react. Price doesn't move randomly. Big money leaves a footprint and we can follow them. That's the banks and financial institutions. So the market moves in a way that seeks efficiency. What does that mean? It means it wants to fill orders at the best possible price. But this process creates imbalance. And what is imbalance? Imbalance, as some of you know as fair value gaps, is the space between the previous candle and the latter candle after the big push. So what price wants to do is that it wants to fill in this thing and get in the move. So now you can see this is the demand zone here. Hear me out. So this creates an imbalance because there's a huge space between an imbalancing. There's a huge space between this candle here before the big push and this candle formed after the big push. So price wants to feel that in. So you can see price trickling down, trickling down, trickling down, and it touches the demand zone that causes big push. But this imbalance draws it closer and closer to the demand zone. You can see we have a nice reaction of it. So this thing repeats itself all over the market. We can see another example here. So this is another demand zone here, and you can see that there's space between this candle. You can see there's space between this candle and this upper candle here. So this creates an imbalance. So remember, this imbalance acts as a magnet that pulls price close to it. See price went up, came down to retest the demand zone here, boom, they went back up. So this repeats itself all over the market, and all we have to do is just to capitalize on it. You can see that this is a demand zone and it has been tested one. So once it has been tested, we don't use that demand zone again because price has already filled the orders there and has no business partaking in it. So the demand zones that we are interested in is the one that price has not tested. So that's the one we can enter at. So as long as we identify the imbalance, the demand zone that caused it, we have a good idea of where price is going to react to next. So that's how you can find good supply or demand zones. So what I'm expecting here now is price will come here, touch this demand zone, and this imbalance, the space between this candle and this candle, acts as a magnet. So the unfilled orders is pulling the price to the demand zone. So price has a high chance of reacting off this demand zone and boom, So all we have to do is just to, depending on the trend, we are on an uptrend, we can set our buy limit over here,
So
and
let's
we can
practice
just
with a setup
join the
where
move as it
supply
goes
and
up.
demand worked
So,
perfectly.
so what do we see here? You can see that price is trending downwards, so we are in a downtrend, and now we can see a big push down away from this part here. So the last candle that caused the push down, that is our supply zone. It will be in the opposite if it was pushed up, and that will be our demand zone. Okay, so the push price is pushed down, it caused this imbalance here because see the space between the previous candle, between this candle and this candle, so it's a lot. So this is going to act as a magnet, so it's going to pull price up to that level. So this is our supply zone. What we are going to do now is to set our sell limit around this zone, put our sell limit on the supply zone, and our stop loss above the previous high, and our take profit to wherever we want it to be. Let's say, but it has to be reasonable. Let's put it at, say, here we are targeting liquidity, so this place is a reasonable zone because price is likely to take out the liquidity here. I'll talk about liquidity in a later video and how to utilize it in the trading, but just know that price tends to take out liquidity to fuel, to power the markets, because the markets and prices are fueled by liquidity. Liquidity just means money. So wherever your money is, the market is likely to take it. So let's play this and see how it goes. You can see prices moving up. Okay. Okay, now you can see the price has touched our supply zone. So this inefficiency is necessary because it's pulling the price up to it. So because there are so many unfilled orders here, the market is trying to get up there and fill it at the best possible prices. And another reason why you can see price reacting off it and going into our take profit is because institutions that sold off here saw this level, which is 1.109113, as a good level to sell at. So there's a good chance that if it comes, the price comes up there again, they'll say, okay, this is a good chance, this is a good price to sell at again. So why not just look at that and see, okay, let's just follow the big money. Since banks and financial institutions are selling there, me too. Let me also sell there, and we can see how it's playing out because we are following the big money. That's the good thing about supply and demand. We get to follow the banks and financial institutions and see what they are doing. So let's take another example. Let's take a demand zone, for instance. So this is a perfect example of a demand zone. Say the last candle before this humongous push here. So we know what's going to happen, right? So we mark our demand zone, and since we know that there's this imbalance here, we know that price, this is going to act as a magnet. So it's going to pull price to our key level, our zone of interest, our ZOI, our demand zone. So we are going to place a buy limit here. A buy limit is an order that you tell your broker when price reaches this point to, okay, buy so amount of assets or stock from it. So that's what a buy limit is, in case you're wondering. So let's see how price reacts to this demand zone. Okay, so that we are tapped in, the inefficiency, the imbalance is doing its job. So it acted as a magnet to pull price towards our demand zone here, and we have hit take profits 2.55 R. So that's it. That's the concept between supply and demand. You can use this to gauge where market is going to, the price is going to react off, and you can join the move. The reason why we join is because the banks and financial institutions put a large amount of money here, so they push the price up. So, and we know that when price reaches this zone again, there's a good chance that they might buy from there again, and the orders they left there, live with this imbalance, is going to also fuel the prices to push up. So we just we are joining the move, we are joining the money. So as we are joining the right place of the market, we see profit. So now you can see that as clean as that setup looked, the market doesn't owe us a win. Sometimes you can see a demand or supply zone working. Sometimes you can see price blasting past rates. Professional traders don't avoid losses. The what differentiates them from amateur traders and professionals is how they handle those losses. So a proper risk management, they can limit their losses and make sure they make more when they win than make than when they lose. If you enjoyed this video, don't forget to like, comment, and share to your fellow traders, and comment down below what you learned or what you think I should have improved on. And I'll see you in the next video. Bye.